Hello and welcome to this latest edition of Courses on Demand brought to you by Forex Academy. In this course, we will be discussing market analysis. There is, of course, inherent risk when trading these financial markets. So, as we begin, please do take a moment to familiarize yourself with the following disclaimer. Now, in discussing market analysis, first and foremost, we must outline the difference really between trading versus investing so we can grasp an idea of the market participants that are trading in these markets and whether they look to hold positions for short, medium, or long periods. And that brings us into discussing and really developing upon the trading schools of thought. So, what we have is fundamental analysis, technical analysis, and sentimental analysis. And these traders, whether they have a hybrid of different trading strategies or not, will take on board some of these feelings or objectives into their trading. Then we'll be looking to trade these perspectives on some price action charting just towards the end of the lesson to actually practically apply what we have discussed throughout the webinar. First and foremost, let's try and define the difference just in a layman's expression with trading versus investing. When it comes to wealth creation in equity markets in particular, investing and trading are two very different approaches in generating profits in the financial markets. Okay, so let us imagine today that yourself perhaps and a friend bought an equal amount of seeds to sow in a garden or field. We then sold, I sold my seeds in a day because I could earn a profit. So I've traded, I've made a trade and I've earned a profit. That's great. Your friend, on the other hand, sowed the seeds and let them grow for a few years till they gave or created new seeds. He then sowed the new seeds and continued this for years and sold a lot more seeds eventually than were initially bought. So obviously he has taken much more of a longer approach to developing his seeds, to developing his purchase, and invested those seeds in future prospectus. By investing his seeds, your friend has made profit in quite a different way than what you made by trading your seeds. Okay, so two very really big stark differences here in terms of discussing trading versus investing. First of all, the time period. Obviously, I've decided to buy the seeds and sell them in a very quick period of time. I've made a short-term profit. That's absolutely fine. Now, your friend or the guy who decided to invest these seeds, obviously in growing more seeds over a longer period and probably growing his overall perspectives or project, would have, of course, made more money on this one particular trade, but would have taken or accomplished a lot more time towards this project. That is the same for investing over a long period of time. So if you're looking to purchase perhaps equity shares in Google or Microsoft or a company of your choosing, you will be looking for long-term growth. Whereas an advantage, I suppose, to the trader there, it is a short-term profit. Perhaps that transaction was completed in 30 minutes or 1 hour. I could make potentially thousands of those smaller transactions and still make profit and buy potentially lots and lots of seeds and sell them, resell them at a higher price. So there's a big difference in actually these two approaches, but they could both be very profitable approaches to trading this market in particular. So just a food for thought there. Let's delve in a little more detail the differences between trading versus investing. The time period. Trading is a method of buying or selling a security for a shorter time period and for shorter term profits. Today's liquidity allows quick entry and exit, and profits can be due to leverage. Okay, so we know that perhaps as Forex traders, we can trade, we can use leverage to trade very small amounts of currency, but actually to make much better profits in terms of the relational move in the currency pair. Investors choose to invest capital amounts for longer periods and hope not only to profit from price increases, but profit from ownership as well. So obviously, if you're looking to invest perhaps in a commodity index or in a share, particular share of your choosing, you're looking for capital growth. So you're looking for the price to increase over a long period of time. But there are many potential upsides as well to perhaps owning the shares that dividends, obviously corporate earnings can affect you there, and you can look to actually build a portfolio based on actually owning the physical shares as well. Capital growth, taking us on nicely to discussing that. Trading, on the other hand, focuses more on the movement of price and is based on more skill from timing. Investing aims to create long-term value and is less worried about shorter time frames. Okay, so that's very important to note. As an investor, we're not particularly worried about what time of the day that we enter this trade. Perhaps if we are concerned with perhaps owning these shares for a 1 year period or a longer time in search of value. So that is very important and potential upside in investing, and also the time focus of trading in terms of that capital growth. You could be in a trade for 1 day or for 3 hours or for 30 minutes, depending on how you're looking to trade the markets for that capital growth. And art versus skill is a good discussion and brings a lot of analysts to actually to discuss the real techniques involved in both trading and investing. Traders are most certainly skilled. We have many technical individuals who time the market and learn market trends to hit higher profits in a stipulated time. Investors analyze the stocks they want to invest in, and investing includes learning business fundamentals and a commitment to stay invested for a longer term. So we do know in terms of our research that it is really much, I suppose, an art investing. A lot of research goes into your fundamental analysis, whether you're a short-term scalper or looking as a technical trader for price points or inflection points or very structured technical analysis to give you your trading signals. There's a certain skill as opposed to the art in investing there within each time period, respectively. And risk, of course, is of high and keen importance here in terms of discussing trading versus investing. Trading involves high risk due to much higher possible returns. Okay, so it's very important to note, and more frequent trading. So obviously, traders, the reason why we look for those returns, and in terms of the investment community, it's a very different discussion that you do have. You often get investors asking, well, how much return do you make as a trader? For me, I really find that a strange question because it's not relative in terms of return and owning a portfolio of assets over potentially a 1 year period. You're looking to get more stuck in there in terms of trading the markets, actively trading the markets. You might make 500 euros in 1 week, you might make 2,000 euros in 1 week, you might make 20 euros in 1 week. So it is relative to your account size and how you trade the markets. Sometimes you're trading very well, but it's the consistency over a long period that defines and makes you a definitive effective trader. Whereas investing involves lower risk and return and is often a more complex function of price, interest, and potentially dividends if you're looking for growth as well. In terms of return, because you're looking to effectively, what you're looking to do as an equity trader is outperform an equity index for higher return. Let's say the S&P 500 is returning 6% in 2018. We will be looking as long-term investors to outperform that equity index, to really perform in terms of beating the index and make a higher profit. However, in relation to trading, obviously, if you were looking to trade the markets more actively, perhaps very actively for 1 year, 6% over a 1 year period most certainly would be not a high target at all, and wouldn't be respected as actually looking for those sort of more long-term approach targets. Let's discuss then our trading schools of thoughts. So first and foremost, fundamental analysis. Well, what is it? It is the examination of the underlying forces that affect the well-being of an economy, industry group, or company. So it's very important to understand fundamental analysis isn't just trading, or it isn't just investing in stocks and shares. You can have fundamental analysis in a gold market, in the commodity itself, in any commodity there, coffee, sugar, wheat, oil. So anything that you really can do research in to get more knowledge on the fundamentals, perhaps the supply and demand function of that market, is of particular interest to you. As with most analysis, the goal is to derive a forecast and profit from future price movements. Okay. Technical analysis is a methodology for forecasting the direction of prices through the study of past market data, primarily price and volume. And really, that's what all the technical techniques in terms of technical indicators point to. They point to either primarily a change in price or a change in volume market participation. So technical analysis is that study where we use these technical tools. We look at previous price action to actually get a formulative idea of where price is more likely to move to. Then we develop our probabilities in trading those in terms of stacking the odds in favor as a technical analyst, and then trading, pulling the trigger to actually get involved more heavily with these markets than a fundamental trader. And then sentimental analysis, it focuses on identifying and measuring the overall psychological state of all market participants. It attempts to quantify what percentage of market participants are buyers or sellers. And obviously, we know they're both called bears and bulls, respectively. So, we have our trading schools of thought. We often see traders or investors develop a myriad of trading strategies, or perhaps a hybrid approach, whether they combine all three or whether they choose to combine one or two together separately. Most traders will develop more of a hybrid approach to actually trading the markets, and it does depend and is indicative of what asset class you'd like to trade or invest in. So let's discuss in much more detail fundamental analysis. What we discussed there is the examination is the underlying forces that affect the well-being of an economy, industry group, commodities, and companies. So what does that mean? Well, let's say that we want to trade the FTSE. Fundamentally, we want to invest in the FTSE perhaps, or perhaps we are looking for opportunities away from the FTSE 100, perhaps in more central European markets, and we're looking to outperform these equity indexes that are perhaps generating 4 or 5% per year. Then we can actually look at the FTSE and analyze it fundamentally with perhaps the top 10 performers, understand why the market is perhaps underpriced at the moment, or in relation to what's happened in 2017-18 in terms of depreciating sterling, that might have and certainly has had a strengthening effect on UK assets. So there's some fundamental analysis in the well-being of that economy, in how things and assets are priced within that economy. Let's go into industry groups, and we know that London is famous for its financial services industry. We can certainly do a portfolio of research there. If we find that that is performing well, we can use that analysis to look for our opportunities, and we know what companies are perhaps under and outperforming within the UK at the moment. So we can use all this research together to really combine a portfolio of our research to give us an idea of value. Is something under or overvalued, and make an assessment as such. If it's undervalued, we'd potentially look to buy that asset, and if it's overvalued, we potentially look for selling opportunities, or look across different sectors for correlated markets to potentially buy those or invest in those assets. So there is a lot of research that goes into our fundamental analysis. Let's take a case here. So what we have here is a bit of comedy sketch, I suppose, with OPEC and Saudi Arabia really leading the charge with OPEC. We have the market share pamphlet that we have, and then the quote is "fracking Americans." So we know that they have been really investing a lot in this new process of fracking, of drilling down and finding oil and gas beneath the surface of the rocks. That has led over the past 5 years to a huge surge in supply, US supply in the oil market. So what do we do as a fundamental analysts? How do we approach this? How do we approach, first of all, our research in this environment? How could we potentially assess trading opportunities? Well, let's move on to actually discuss a bit more fundamentals of the well-being, again, of the economy. We have what is known here as a shift or an increase in demand from D to D1. So just with the right hand picture there, we can see our axes. We have WTI crude oil price and the quantity, or that would, I suppose, that's indicative of demand supply. So you can see as there's a shift in demand from A to B, that actually will be reflective of an increase or decrease in price, given what will happen. So with our example here, with this, the increase in fracking in terms of US production, it really caused an increase in surge over the past 4 to 5 years in the oil market. We know that OPEC and many oil producing nations have tried to combat this by introducing supply cut extensions, and these are still ongoing in the oil market to look to actually manipulate the price of oil or to keep it above, I suppose, the $50-$60 level. We did see a very strong sell-off, cause a shift in demand, and obviously an increase in the price of that commodity itself. And we often see these retractions or contractions in supply cause a shift in demand, and therefore price react in such a fundamental way. So that's a a fundamental analysis case in the oil market. As a trader, you could position yourself for long-term price gains in this commodity, and certainly that's something you could have done in 2017. Say at the start of 2017, oil was trading around $35-$40. It's now at 60 $65, and we're seeing that price fluctuate in between 60 and 65. So certainly a lot of growth in the oil market, and that's a result of a lot of these fundamental changes or shifts in actually pricing or looking to price the asset. Here we have a price action chart in front of us. This is the gold market, and we see that we have quite a lot of technical analysis already inputted onto our price action chart. Now, these are daily candlesticks, so each of these trading periods represents one day in the gold market. At the very high, we have a long-term resistance level there, and that's probably providing some support for sellers in this market in terms of looking to fade this long-term strength in the market. We can see there roughly around 6 months ago, it was trading quite strongly up to that level and immediately reversed with a very bearish trend indeed. In regards to more relative price action, we can see that it has touched the level of resistance one, two, and three times almost, and obviously that is the high of our Fibonacci retracement from the more relative low to high of the market. So that would possibly provide us with an indication technically that this market is not looking to continue to the upside. Now, do bear in mind that using these technical indicators do conflict trade ideas at times as well. If we look at the moving averages, we have three respective lines, one being a 200-day moving average, that's a red line. Then we have a 100-day moving average, that is our green line. And the more, I suppose, constructive to more recent volatility is the orange line, which is the 50-day simple moving average, and that will move in relation quickly move to new changes in price in this market. And that will give us an overall trend structure to the upside that this market is actually bullish over those time periods, which will actually conflict perhaps with some of the technical analysis. So you do need to know what type of trade you're looking for, what term of the trade you're looking for as a technical analyst, and what those other measures, perhaps like observing the daily volume and the relative strength indicator, will assess and perhaps accept or reject your trade decision. We can see that the volume did experience an increasing momentum with its volatility in the most recent price action. It is now looking to decrease over the last three trading periods, which maybe would suggest as well that there is a decrease in volume in terms of looking to buy this market as it reaches new highs. Then we see relative strength indicator. It really isn't giving us a signal. It's roughly around 60 below or 70 overbought period, but it's up there. It's getting close to that level, so it might be something we could consider. So that is what we do as technical analysts, looking to combine many different indicators, technical areas or price inflection points of perhaps historical pricing in a market to actually give us an idea to look for trading opportunities and to stack the odds in our favor in terms of probability. Now, in applying technical analysis to a more structured short-term view, we call these traders or technical traders price action specialists. And many traders look to use technical indicators as well as observing and trading the price action to give you an overall technical structure of the price. My question that I would like to pose is, how would we assess this chart just due to the price action to look for potential trading opportunities? Well, let's do some analysis here. We have from low there, we have a bit of a trend to the upside, and as at the bottom of that trend, we can see a bullish hammer that would potentially give us a signal that there's no more selling opportunity after that candle close, and that potentially the market is looking to reverse. It certainly does and causes a very bullish trend in the gold market to the upside. We can see that supportive of trending candlesticks. We see a very, very constructive trend to the upside over perhaps 2 weeks price action. So that would indicate the overall trend structure is very solid in terms of bullish momentum. We see an engulfing bullish candle, just breaking up for a little from a little level of price consolidation. I'll just point that out in terms of um, addressing the market itself. We see this little trend structure in here, and then we get a break just above with this bullish candlestick, giving us a signal that there's potential more momentum for this market to continue to the upside. We then see the reversal indecision with our candlesticks up towards the top of the market, and that would indicate perhaps just looking at the price action, we like to call these areas double tops. So I'll just draw this in that we can see this double top phenomenon. That would indicate to us that we're not actually getting continued strength to the upside. With the candlestick structure themselves, they're certainly rejecting price movement in terms of bullish activity. Then we see something quite significant. We call this candlestick a bearish dragonfly, which actually tries to break a level, a very supportive level, and then close above the level, which it actually has closed quite a bit above this level indeed. So that would indicate we have some market support in and around our level here, and it's bullish market support. So we're still looking for buying opportunities, perhaps as a technical analyst, or perhaps if you like the selling opportunity from those highs with the reversal and decisions, you're looking for more of those. Again, what we see with the most relative price action just in and around this point is a market exhaustion. Again, that's the gold market, so it's from our long-term high. It is a lower low. It is a lower high from the most recent price action again, with the third, I suppose, shoulder in terms of looking to trade to the downside. And this could be an idea for us to look for potential trades to actually sell this market to the downside. So that is what we do as technical analysts, to use the price action. Whether you're a price action specialist or you like to combine technical indicators as well, or simply make a hybrid approach, indeed, that is how technical traders will look to actually formulate price discovery and make trades. So let's move on to discussing a sentimental analysis. Sentimental analysis aims to assess at all times who is in control of the markets. Trading decisions can be made on either a short term or a long term basis as sentiment changes in the marketplace. Shorter term traders will look for news events to cause a sentiment shock, while longer term traders will take a longer approach to the bullish bearish outlook of the market. So it's all about assessing who is in control of the market at any given period, at any given price point when you're actually looking to trade that time period. So whether you're looking to trade daily candlesticks, only daily candlesticks, perhaps that structure, you'll be looking for longer term trades. If you're looking for sentiment shocks, you maybe break that day down into assessing the 5 minute candlesticks and looking for sentiment to tell you who is in control of that time period in the day where the volatility is suggesting there's a price shock, or sentiment is shifting. So what I'd like to pose is a couple of charts here we can actually assess the market very basically itself. And it all leads into just focusing on the sentiment or the feeling of the market at that time. So who is in control of this market? Well, what we see is a very clear trend. Now, I know this is related to actually studying the markets with price action and technical analysis, but this is purely speculative on sentimental analysis. By judging the market, we can see that there has been a level of recovery. So that is more of a value question in terms of its fundamental approach. There is a level of recovery in the market. It's trending up, and the market is very supportive in this long-term price trend. So if we are trading this in the long term, and again, these are daily candlesticks here in our pound Swiss market, as a Forex trader, we will of course develop more of a strong sentimental approach to price growth, or an appreciation in this currency pair. Let's move across to yet another currency pair to potentially assess that chart and really derive an idea of, again, who is in control of the market. Here we have the Canadian yen market and Forex pair, and we can assess it purely from a sentimental approach again. So again, these are daily candlesticks, and I'll just highlight that in terms of the actual price chart as well. We have daily candlesticks on Canadian yen. Who is in control of this market? Well, we see a very well structured trend to the downside. So initially, just by looking at the market, we have a directional bias. Of course, we do. As a sentimental trader, it's all about your feeling of the market, and the market participants, or who is in control of the markets, are certainly looking for selling opportunities in this market. We can see, apart from the trend structure moving very much strongly to the downside, we can see that buyers don't even enter the market. Really, we have one buyer, and that is quickly outdone with some price movement to the downside. We have a second buyer again, price movement to the downside. A buyer comes in potentially looking to trade the market up, as buyer 3 will call. We see continuation to lower prices. Buyer 4 again. So you can see where I'm getting at here. Sentimentally, we are thinking there are no buyers in this market, and we're seeing this trend structure really start to push to the downside. Again, it does lend itself to discussing it, and that is why a lot of these traders do take on a technical fundamental approach and hybrid their trading strategies. But sentimental market participants, again, potentially if you're not a trader but you're an investor and you're looking to judge sentiment in the Canadian Japanese yen, you're going to observe this market, and what you can see in terms of the price structure is that the market wants to trade down, and our sentiment is bearish. We're bearish this market, and we're looking for selling opportunities, or potentially waiting for the market to change, our sentiment to change, so that we can look to buy this market. And that is a very, very important point as well for sentimental traders. Potentially, some traders will have fundamental analysis, perhaps for the Canadian yen, and are simply looking for buying opportunities, given they need to make an investment in such a market. That is certainly the case as well, and you can get very good trades off just due to how the sentiment perhaps will shift in terms of a short-term shift in sentiment. Let's move across to our third and final market when considering sentimental analysis. We have the gold market again, and what we see, this is a more relative price action that we have viewed over the last two charts there when discussing technical analysis in different time frames. Here we have the most recent relative price action in the gold market, and what we can see here over perhaps a month, maybe 5 weeks of trading, is that there is no strong sentiment in this market, and that can answer so many questions for you as a sentimental trader. Who is in control of the market? Well, neither bulls or bears are in long-term control of this market. It is up in and around not long time highs, but certainly highs of the past 3 years. So it is an area of interest for sentimental analysts and traders. And we're looking for opportunities to really see a shift in this sentiment. Is the price going to really break through our long-term level? Then sentiment will really shift, and all these short-term traders will really change their sentiment in terms of being bulls in this market. If that is the case, I do not need to know why as a sentimental trader. I just need to know that I want to follow this sentiment as the market shifts. Potentially, as we discussed with our technical analysis, that we did have a bit of a price structure at this resistance level here. So potentially, just think logically of this as a trader. If the market trades down and looks to break this level, could we argue that, look, the sentiment is shifting to the downside in this market, and market participants, or who is in control of this market, is actually changing towards the bears? Certainly the answer will be yes, and to take that into consideration in our sentimental analysis. So let's just put that all into detail in terms of judging potential trading opportunities. What I would like to look at, just to finish off, is a market analysis with different perspectives here. And obviously, the question is, how do traders analyze the markets?
Well, in our study of market analysis, we know that primarily we have three main schools of thought. We have fundamental, technical, and sentimental analysis, and those traders obviously look to position themselves with a different decision-making process as traders in the markets. First and foremost, we have a price action chart here in front. It's the Chinese A50 equity index. So if we were first and foremost perhaps a fundamental trader, how would we look to trade this market? Well, overall, we know that we are in a very strong bull market in terms of how global equities are performing at the moment. So that leads us to observe our long-term price trend, and obviously we have directional bias to the upside. Secondly, we understand the construction and manufacturing sectors of the Chinese economy to be very strong and very important in the overall growth story. So such tech firms are outperforming, and that would lead to continued growth. We know that industry and construction is very important as well, and we have seen bull markets in such metals as copper and aluminium over the past year. So that would lead us to speculate that there is strength latent in this market, and we're looking to follow this momentum to the upside. How would we position ourselves as traders fundamentally? Well, the question is always of value. We look for value opportunities. Perhaps we follow an investor-led buy the dip sentimentality, where we can look for opportunities to actually buy this market to the upside with a very strong directional bias, fundamentally that this market is strong. How would we look to perhaps trade this market if we were to apply our technical analysis? Well, first and foremost, we can see there is a very obvious trend to the upside. So that confirms our technical directional bias to become a buyer. Okay, then we look for opportunities to perhaps follow a price channel. We can see a few very well defined price channels here, which lead us to upwards momentum. But remember, as technical traders, we're looking for perhaps levels of price consolidation. So we can see one here within the middle. It actually starts to follow and consolidate a trading range. So we can look for shorter term opportunities, perhaps within this range. If we don't want to trade the long term, we could buy and sell, of course, the lows of these trading ranges. And then when the price structure breaks down, we have still a directional bias to the upside. We follow the breakout to the upside when that occurs. Also, remember, we are technical traders, that we can look for shorter term opportunities in potentially some sentiment that may shift the market in the short term. By simply looking at the Japanese candlestick structure here, we can see that we have a very strong candle engulfing Mariposa to the upside. Then we have a doji or indecision candle, and then a complete reversal from the next candle there. So that would lead us to speculate that there will be some continued in the short run trading to the downside. So a few potential trades there, obviously, both in the long, medium, and short term trading opportunities for the technical trader. How would we perhaps look to trade this market if we were to base our decisions purely on a sentimental analysis approach? Well, simply by looking at the price action over the long term, we can answer the question, who is in control of this market over that long term? Of course, it is the bulls. So sentimentally, if we take a directional bias, we are, of course, buyers in this market. Then we can also look for short-term buying opportunities when we see sentiment candles, and these would be the, think about an actual candlestick structure where there's more volume, perhaps there's more trading, and the ATR is greater in the candle. That would lead us to say there's more momentum and the sentiment is stronger in the move itself, or perhaps a well-formed range where there's clearly total control from the buyers that would focus our attention on actually trying to capture these buying opportunities as a sentimental trader. We also know sentimental traders will look at short-term shifts or changes in the sentiment. So to name another example here, we see a very, very significant change in sentiment that leads to the market actually pulling back from new highs for a quite sustained period, perhaps 1 week, 2 week period, and then forms a range. So definitely a good trading opportunity there. By trying to find these areas, here is another one where perhaps the market has reached a high and sentiment is changing with the feel of the market. Participants are changing, and the direction of price movement is as a result changing and allowing these trading opportunities. So there we can see three very different perspectives in how to actually look to trade these markets, both fundamentally, technically, or sentimentally. And the answer or question is really up to you as an individual trader, whether you want to delve into one particular school of thought, or maybe embroider or combine all of these approaches into your own hybrid style of trading, and that will develop your own trading strategy, of course. So let's move on to the webinar review. This concludes the lesson. What do we learn in this lesson? Well, we learned the main differences between trading versus investing, whether it is based on a time approach to your own trade, or perhaps you're looking for value as opposed to actually looking for short-term price speculation. Then we discussed the trading schools of thoughts, obviously in a lot of analysis within the webinar. We have fundamental, technical, and sentimental analysis on how traders can actually position themselves in the market. So that brings us to the end of this market analysis webinar. Thank you very much for joining us on this installment of Courses on Demand, brought to you by Forex.Academy. We do hope to see you very soon. Bye for now.